Yo, what's up, guys? Friday the 18th. I'm bringing Scotty back. So we're going to talk a little bit about some of the stuff that he likes to follow, other than the Red Sox, as you can see on his shirt. What's up, Scotty?
How you doing today?
Doing all right, man. Just digesting some of the stuff in the market, and we want to get into. We'll get into a little bit what's going on with the mortgage-backed securities, and then Scotty's going to get into some of the 10-year because that's what Scotty likes to look at. Traditionally, everybody follows the 10-year because that is a bond. That's a long-term instrument, and mortgage-backed securities is a long-term instrument, and it's easy to see what the 10-year is doing on any of your websites. Most of the time, you have to get some sort of subscription to see what the mortgage-backed securities are doing. So what we're going to do is we're going to talk about the mortgage-backed securities a little bit here and show how they kind of correlate with what's going on with the 10-year. So this is your Fannie Mae 3.0. This is what we're typically looking at least our side, because it's the highest coupon I can look at here, even though our interest rates are about 1 to 1.5 higher than even what this coupon rate is. So the coupon rate of 3% means whoever invested in this pool is going to make a flat 3% return on their money. Now, the trading and when they put that money out there, as far as the trades and securitizing and then funding loans, there's going to be margins in that. They're going to have to increase the rate from 3%, which is what they're paying to get the money, to handle the servicing, the securitizing, and pay all the people to do the jobs in there, the enormous amount of compliance work that has to go to stay compliant with what the federal government has as far as regulations that we have to follow, the Dodd-Frank Act, state legislate or state banking regulations, federal banking regulations. There's a lot of that in there. So back when Scotty and I were working together before, prior to the crash of 2008, 2 or 3 people can get a loan done. Now I need like 13 hands to touch one deal to get it all done because of all this extreme regulation. That's why there's such a gap between what you're going to see in a coupon rate of 3% right up here versus an actual interest rate. Now, we're not pulling from this coupon like we talked before. We're talking, we have to go to aggregators to get this money. It's not coming from Fannie and Freddie. So as you can see, these last few days, we've taken a beating. Taking a pretty heavy beating. This is when the Fed's been talking. This is when a lot of this inflation concerns coming out. In fact, this morning, St. Louis Fed President James Bullard spoke on CNBC. He was very transparent about his views on inflation and when the Fed should start hiking rates. But he believes the Fed was surprised at how much inflation we've seen and thinks that there's some potential further risk that we're going to start seeing here. Now, they also believe, there's a median forecast that they believe that the PCE, which is the Personal Consumption Expenditures Index, will probably start dropping in 2022. Right now it's been averaging 3%, a little bit hotter than that lately, but they believe it'll start dropping a bit in 2022, start to get a little bit more back to normal in their words of normal, I guess. But when you're talking with James Bullard, his thought process is there's going to be some spillover. So it may not get back to this 2% range till like 2023. So he also thinks that the Fed needs to be pulling back on buying into mortgage-backed securities. What did they say, Scotty? $140 billion a month or something like that, or $120 billion a month?
I think it's $120 billion a month right now for mortgage-backed.
Yeah, so the Fed's buying $120 billion a month to keep these rates lower. Right. But when they start talking inflation, investors pull out of that. The Fed's dumping in while investors are pulling out. Why would they pull out? Well, if inflation's going up, we've talked about this a lot, the dollar's devaluing, but they're getting a flat rate of return of 3%. They don't want their money being lost like that. Now, the Fed doesn't care because it's not their money. I say they don't care because that's my interpretation. I would imagine that it's not as a big risk for them as the average person investing there. But when you're talking about what Bullard's talking about, he's thinking that, we have a booming housing market. We may have some sort of other risk with respect to a housing bubble. So he believes the Fed should start backing out of mortgage-backed securities. So when they do start to divest some more or slow down their purchasing, they are definitely going to start pulling back on, at least my interpretation is they're going to start pulling back on mortgage-backed securities long before they start pulling back on treasuries. So let's get into the treasuries. This is a chart that's actually a couple days old, but the reason I pulled this chart up because Scotty can share with you a couple things. You'll see these white arrows here, and there's a reason why we marked that. And it was actually marked by a bond trader who put some information out. about his trades, and he says he's not going to start trading this market right now because it's too crazy. But share with everybody, Scotty, your thoughts on these white arrows and where we sit, where my cursor is.
It all stems from the market, and there's a perception that what everyone sees with the 10-year, that correlates to what's going on in the investor market. And that's mainly 99% of our business. So when you walk by the TV and see that the 10-year is dropping, our phones tend to light up and everyone's hoping that rates are dropping. But again, one doesn't correlate with the other. What the investor market does and what the primary rate market does, which does tie to the 10-year, again, they don't correlate. So if you're working on something with a primary residence by chance, this is awesome as the 10-year goes down.
As far as us investors, we're not going to see, especially since I think the main reason we're not going to see it is because we're not tied to the markets that we were before. We're going to the aggregators. They're putting up their own capital. It's not going from Fannie and Freddie. And one of the things we are noticing in the markets, I was referencing, this is all market driven. You see right here, these marks we put when the Fed speaks. And you can see every time the Fed has spoke in the last couple of times, it's taken a beating in the market. Well, the Fed spoke again right here, right? So then we saw the market decline again, but we always see it start to climb back. I don't know what it is about this knee-jerk fear that happens every time the Fed starts talking, but bond traders start getting out of the market until I think enough people get out there like, okay, the price is pretty good, we can go ahead and buy. So you start seeing this line here is where he set, is his buy line.
It always takes a couple days for it to shake out from when they speak. And what they speak about is never anything super negative. It's not always super positive, but it's nothing. The market, for some reason, just overreacts every time the Fed speaks.
I think a lot of the overreaction, correct me if I'm wrong, Scotty, I believe it's just since one person starts to freak out and divest, and it starts a chain reaction where everybody starts to do that, right?
Correct.
So it's a lot. It's kind of like it'd be like a crypto craze, right? We start seeing it start to jump up. Everybody's going to start buying into it. And then of course it's going to exhaust itself and drop back down again. So there is a lot of market movement based upon a person's emotions, if you will. There's a lot of emotional investing going on.
We're in markets where one person speaks and it has a massive impact, whether again, it's to crypto, or the bond markets or treasuries or even stock market. One thing can, in today's world, like just trigger a negative and a positive effect. It just seems more so often than not, it's negative.
True. And so the one thing we want to tell investors is don't get so wrapped up in what's going on in the market. Yeah, it's good to know what's happening out there, get an idea what's going on, but don't get so wrapped up in it that you're going to try and time the market. We talked about that a lot. It's a lot like being a football player sitting on the sideline, sitting on the bench, resting for that perfect play to jump in there and get on the highlight reel. Doesn't happen if your ass is not on the field. You've got to be on the field all the time. And the only way to be an investor is on the field. Now, you're not always going to time the market perfectly, but you're going to do enough deals that you will get those market time deals that are going to work out. On top of that, it's the long game. We've talked about this over and over and over again with inflation doing what it's doing versus the long-term leverage on real estate with a 30-year fixed loan. There's no lose in this. The only time you lose is when you don't stay in it. Or if you don't set your baselines and you buy on irrational thought processes. Set your baselines, buy correctly. If you're buying within the baselines that you have, the formulas that you follow, there's no reason why you should start freaking out, backing out. There's always a deal to work in every market. Final thoughts, Scotty?
I just spoke to a borrower the other day. I think he's close to purchasing 10 properties with us, and he looked at it a way that I guess I never kind of step back and look at it. I'm a firm believer that rates are what they are at the time you're doing the transaction. It's just part of the business and part of what you do. For myself, if I'm buying a property, the rates are what they are. Do I want the best deal? Absolutely. But am I going to sit there and wait and gauge the market to try to like hit it on a perfect note. It's no different than trying to sell a stock at its all-time high. It's really hard to predict, but the way he approached it, coming on to almost his 10th property, and when I told him what the rate was, he goes, "That's fine." He goes, "You know, when I look at all the properties that I've purchased, and you guys pretty much done every mortgage on it, is, you know, we were locking these back in, you know, November, December, January at somewhere in the threes, and now we're somewhere in the fours." And he goes, "When I kind of look at it as like kind of cost averaging," he goes, "all the ones I have in the threes and now in the fours," he goes, "I have an average of just say 3.85% is the average on all my properties." And I said, "I actually never looked at it that way, but I go, it's a different way, but it works."
Yeah, and it does work. It's you got to look at it from all the different angles you can, and that's what we're bringing to is just angles. You've got to make a decision. You're the CEO of your real estate investment business. You've got Scotty with a long history of trading. He follows these things. He understands these things. He tracks the rates a lot more than I do anymore. And the bottom line here is we're here to give you tools. You're going to be successful provided you got the guts to move forward as the CEO of your business, but you got to get the right people on your business and help you make that happen. So we appreciate you guys watching, hitting the subscribe button, passing it on to your friends, and we're going to keep trying to get data out for you. Thanks, guys.
Thanks. Have a good weekend.
Everybody.